24,400 to 24,330.
Pfizer is going to get a 3-year relief from any tariffs.
So 0.1 to 0.18% on the Nifty Bank, 0.19 on the Nifty.
There is a fair amount of liquidity with domestic institutional investors.
The MPC voted unanimously to keep the policy repo rate unchanged at 5.5%.
So it's a good move to, create adequate demand from the bank side to lend more.
Should we understand there is space for more than one cut?
Inflation has reduced considerably since we met earlier in June.
As far as the large exposure framework is concerned, that continues on an overall systemic level.
M&M, that's the stock on our radar, beat street estimates with total September sales coming in at 1 lakh units versus estimates of 90,000 units.
Well, that is the day so far, and it really did turn out to be sort of decision time at the RBI, right? I mean, the decision has been no change, but that's hardly, I think, the right description. Lots of changes on the regulatory front, and I think the market is taking note. There is, of course, space, as you heard Lata in that recap of the day so far, asking the RBI governor essentially saying, well, there is space which is opened up. But even here and now, there is a fair bit, and all of it seems to be aimed at easing and trying to kickstart growth across a range of these measures. That's going to be the focus here. This is Closing Bell. We're coming to you live from the CNBC-TV18 News studios. I'm Prashant. With me, Surabhi and Nigel. Guys, hi, afternoon.
Afternoon, guys. I guess the governor also decided that it's festive season to give a pataka policy. So let's get on with it. And I haven't seen this kind of a market reaction in a while after a central bank policy. And it's that, that statement, the moment that statement was made, that space has opened up for further policy support, the market took off, and then we had a whole range of regulatory measures, which we'll discuss, which are supposed to make lending a little easier to foreign acquisitions, to infrastructure projects. That seems to have caught the bull's imagination.
And after 8 sessions on Closing Bell, we are set to end in the green. In all probability, we're going to be breaking that losing streak. And it's looking good, actually. Portfolios will be feeling good, going by the breadth of the market. The Nifty Bank is the big leader today. That's crossed the 20 DMA as well, and looking quite good as we speak at the high point of the day. Well, let's tell you actually what we have on the show for you. It's an action-packed hour of trade coming up on Closing Bell. Let's tell you what we have. Good day for trade on the last street. The Nifty inching closer to around the 24,800 mark, just crossed above that. While it's green across the sectors, the banks leading from the front. The Reserve Bank of India moves to strengthen India's banking sector. Measures unveiled ranging from much anticipated ECL framework to lending norms to aid credit flow. Shares of ICICI, HDFC Bank extend gains. Auto sales for the month of September have started trickling in. The likes of Bajaj, Mahindra & Mahindra, Escorts. We'll assess those figures with our guests in just a bit. And we have 2 new entrants on the bourses today. EPAC Prefab makes a debut with a 10% discount, while Chain Resource Recycling, well, that's listed with a big premium of around 14%, and that's doubled up to around 30% as we speak. So good times after a while. Well, how do you position yourself on the final hour of trade? Mitesh Thakkar joins us on the show from Bonanza Portfolio. Hi, Mitesh. Good afternoon. What do you think? Relief rally, or we have more to go out here? Because now the Nifty is gradually moving to around the 20 DMA. The Nifty Bank has taken off the 20 DMA, and there was a strong case to see a bounce and break that losing streak. But from here, what?
Good afternoon. So I was talking about this fact that there is possibility for bounce back to about levels of 24,850, 900. We are practically there. I think getting past 24,900 will give me a lot of comfort that we have a genuine reversal in place. As of now, I think if people have bought at lower levels, these are the levels to take some profits off. Wait and see if there's strength to get past 24,900. But the good part is the Bank Nifty. The Bank Nifty has managed to clear 55,150, which was the immediate supply pivot, and now can even get up to about 55,650 to about 55,700. So there's space over there, about 300, 350 points on board. And that could propel the Nifty. But I'm not sure whether we'll get past 24,900 immediately. So not taking an index long trade, but we have some financial names on the buying side. So Kotak Bank is a buy. Keep a stop at 2049. Look for targets of around 2105. And the other one is Shriram Finance. I think that's also having a very good price volume action. So buy here with a stop at about 632 for targets of just below 632 and a target of around 680.
Yeah, I mean, so much of excitement around Shriram Finance. There's the RBI policy, that's one part of it. But then all this chatter around the possibility of a large Japanese financial conglomerate, Mitsubishi, whether they're interested or not. Of course, the company denied it. But anyway, it's gotten people really excited today. Let's actually kickstart with the big story of the hour. That is the RBI announcing a whole host of measures aimed at enhancing the resilience and competitiveness of India's banking sector. Ritu is here with more details. Ritu, 22. When he said 22 measures, you and I were, almost gasping. But tell us which are the big highlights.
Well, yes, Surabhi, never before, in more than 10, 15 years of covering this policy, we heard of 20 reforms or more being announced in a single policy. But that said, these are big bang reforms that will have some far-reaching consequences and a clear U-turn in the regulatory stance from what we've seen in the previous few regimes. Starting with, let's look at, for instance, expected credit loss is now going to be implemented a little later than expected, only from April of 2027. And banks will be given a 5-year glide path until 2031 to meet the additional capital requirements to make higher provisions. Also, again, to ease the overall capital requirement, the risk weights for lending to MSMEs and for residential home loans will also be eased. More details on this important one is still awaited. This was a draft circular released last year, which had caused a lot of havoc when it comes to subsidiaries of banks like HDB Financial and so on, where RBI had said you cannot have overlapping business between the group entity and, the bank. That has now been scrapped altogether. Apart from this, a whole host of reforms when it comes to lending for capital markets. For instance, for the very first time ever, and this is perhaps one of the most significant reforms, banks will now be allowed to finance acquisitions, paving way for more buyouts and deals being financed by banks. This will also allow, of course, banks to wrestle back some of the market share from other financial entities, banks, NBFCs and private equity players that had come into this space. RBI has also removed entirely the ceiling on lending against debt securities. Lending against shares has been increased 5 times from 20 lakhs to 1 crore for IPO financing, from 10 lakh to 25 lakh per person. Apart from this, there was this proposal in 2016 which came to being in phases, where if a specified borrower had more than 10,000 crores in bank borrowings, they were discouraged from borrowing more from banks and rather meet their requirements through the capital markets. That has been scrapped altogether now. To address the concentration risk, the large exposure framework for bank individual level remains, but on a larger systemic level, RBI is going to look at other macro-prudential tools. It has not outlined what specifically, and to reduce the cost of infrastructure financing by NBFCs, risk weights for NBFC lending to them will be reduced for operational, high-quality projects.
Okay, Ritu, thank you very much for that. That's a quick run through. There are more, but we want to highlight the most important, most consequential in that sense. Harshvardhan is Senior Advisor at Bain Company, is with us. Abhijit Devanji is founder of NeoStrat Advisors. Gentlemen, good afternoon. Great to have both of you here. Prashant this side. To make this interaction as useful for viewers as possible, maybe we'll ask both of you one impact of one each, and we've got about 4 or 5 that we want to really address out of what Ritu also, so, shortening that list even further. Banks now allowed to do M&A financing, right? I think they've been out of it for the last, 10, 12, 13 years. They can do it now. How big is this? Abhijit, if I can start by asking you that, will this spark so far, as things stand right now, a buyer or seller who had to finance this via private credit, had to go outside, dollar-denominated debt, higher interest rates, etc., etc. But local banks can do this now. How significant is this, and can banks really unleash a wave of M&A? Your thoughts?
It's a great opportunity for banks. I don't know why there was a stigma of not being able to fund acquisitions earlier. And I think RBI was a little worried that sometimes it ends up building a bubble. But I think what RBI has realized, it seems to realize, that they'll be missing out on a big opportunity for banks. Now, where lies the opportunity? One is that acquisitive corporates will now be able to access rupee funds, which are generally cheaper. Now, in general, RBI for banks made sure that we were only doing vanilla financing, and hence vanilla rates were charged. However, now with the opening up of M&A financing, various kind of structured financing products will be available. Like leverage buyouts will now be possible in India. Now, what is a leverage buyout? Fundamentally, you're saying that you will fund the acquisition out of the cash flows of the acquirer business by setting up some intermittent financing vehicle. Now, those kind of things will be allowed by RBI, which earlier was done by either overseas investors or private credit was doing it in some form. But now you will find that banks are going to be able to do it. The other thing is private equity firms, which generally were leveraging from outside of the country and putting it as money as India and frankly taking back significant returns. Now, this is a high financing business, and that is what our banks will need to understand. The problem really is, are we going to be able to price this credit right? And that is where I think the expertise of a banker will come into play, because this is normally 15 to 18% related financing activity, which our banks are not used to because of the kind of credit we get. So I think if we are able to finance it right, this is a great opportunity for Indian banks.
Okay, Abhisar and Harsh, thanks so much for joining in. Harsh, comment on this. Maybe you can add a point to what Abhisar said on this particular issue, and then moving to the next one as well, where the RBI, and I'm going back to the press release just to quote, where they're talking about withdrawing the 2016 framework, which had disincentivized lending to specified borrowers, which had a system-wide limit of about 10,000 crores. So what does the removal of this restriction do? I mean, do you immediately see an impact on credit offtake on the corporate side?
So on the first one on M&A, I think it's an excellent step. To Abhisar's point, hi Abhisar, that I think it was a vestige of the 1980s, 1990s thinking that banks somehow should not get into this risky business and so on. We need an efficient market for corporate control. We should facilitate greater merger and acquisition so that our corporates become more efficient. And you can't do that unless funding is available. And we had extraordinarily constrained funding because the largest provider of credit were kept outside of it. So I'm saying this is an excellent step. Obviously, we'll have to wait for the detailed guidelines on this. But I think this is a very, very good step. The other point that Abhisar mentioned, I'll take it forward, that in many sectors we allow 100% foreign ownership. But if a foreign company has to buy a domestic entity out, it cannot leverage locally. Same with the private equity. So all of those concepts hopefully would go away. And I think we'll create a much more efficient market for corporate control. On the second part about the large exposure, I think that time there was systemic concern about NPAs and so on. And it was believed that you can take away these large borrowers from banking sector and move them to bond markets, for example. I think what we have probably realized is bond market, while has grown, it's very skewed. You have to be AA and above to be able to raise significant amount of money. Even single A's find it hard to raise money. And for them, there is no other choice. Anybody rated single A and below is to go back to banking sector. And so I think both these are extremely good measures. I think what they do indirectly is move the burden from regulations to governance at banks. Because to Abhisar's point about high finance and high risk and high reward, the burden that to that extent increases on the boards and the various board committees of the banks to ensure that the consequence of these regulatory changes are managed properly within the banks.
Just just to comment on the earlier point, right, which is M&A financing. This was allowed pre-2013 or something, right?
No, it was in my mind never allowed freely.
Abhisar?
Earlier than that. I think it was much earlier than that.
Much earlier.
Yeah, I think, and it was allowed in a very restricted case of things. I think.
My question is, even when it was allowed, there was not very much participation by Indian banks, right? So will that happen now? That's my.
Yeah, I think, if I may, I think that those were the times when we were dominated by public sector banks. We were probably averse to this. Now we have large private banks who would be far more open and willing to do this. My expectation is.
Okay. Now just to move it along, the overlap has also been in terms of that. So banks which could not do some activity, they used to do it through subsidiaries, NBFCs, etc. And now RBI is saying, well, we don't need restrictions in terms of that, right? We'll defer to bank boards to take appropriate decisions in that sense. So that's a welcome move. My question is, in terms of practical implications, are there any implication? Does this just take away uncertainty? That there are instances where in terms of there's a housing finance subsidiary of a PSU bank. I mean, every once a couple of years, there used to be buzz whether they'll have to sell it. I mean, all that goes away because this is already happening. So does this do anything incrementally? Harsh and Abhisar, go on.
Yeah, so I think one thing is that it obviously takes away uncertainty, because if you had a subsidiary that was doing a business that departmentally could be done by the bank, then there were regulatory restrictions. This came out of the new banking licensing regime, if you remember 2013-14. I think now it will be left to the bank's board as a part of its governance to decide whether that is allowed, that should be continued through a subsidiary. I think the original concern of RBI, if I were to guess, it was some sort of regulatory arbitrage. So banks would run some businesses through subsidiaries and come directly in order to benefit from regulatory differences. I think as the differences between largely NBFCs and banks are being taken away, the perceived arbitrage is being taken away, this regulation is beginning to become redundant. So I think this is the right step. Let the boards of the banks decide what they want to do in the bank and what they want to do in the subsidiary.
Abhisar, you want to add something?
No. So I think very clearly, RBI's view has always been, and now they've kind of unshackled the banks to enable that, is to say that lending businesses should be done through one entity. Ultimately, we'll get to that. Though, of course, the single point of presence remains. We have exceptions, right? There's HDFC and HDB Finance, for example. Now, some stage people are going to say that why do you need so many multiple legal entities just to do the same business? However, if regulatorily you require a separate entity for an insurance company or for asset management company or anything else, that is what I think should ultimately be permitted. So what we are saying, as Harsh rightly said, that let's give the boards the flexibility to manage businesses that are available for a regulated entity to do, but let's try and remove the arbitrage and get it done in one entity. That's one. And the second thing is that I think that the regulatory oversight will only increase. Because now with the boards being more empowered and managements being more empowered to encourage and do all kinds of businesses in whichever way they want to do, the supervision and the regulation, I think, will quadruple, and which it should.
Gentlemen, I also want to move and talk about some of the measures, greater flexibility to lend against shares, higher limits on IPO financing. I thought that was very interesting. But before I get to the capital market related stuff, just to complete this point, the first two measures that we've discussed, allowing Indian banks to finance acquisitions and the large borrower framework as well. Now, while this is a great enabling step, does it lead to a boost in corporate credit growth in the near term, in the visible horizon? Yes, no, maybe, Abhisar?
I think credit growth will depend on the optimism that is there in India.
Yeah.
So if a Chinese manufacturing is preferred, then the Chinese manufacturer shall manufacture and India shall not build capacity.
Yeah.
But I think if we have the ability of opening things out, what the governor has done now is to say finance is available. Now we have to make projects more viable. So for infrastructure, for example, NAPFID has now said that there is partial credit enhancement available, opens up the whole pensions and the insurance sector money available. Now let's make the projects more viable. So I think corporate credit will be driven by what are more viable projects. And the boards obviously will have much more onerous responsibility of making sure that they only fund viable stuff.
And Harsh, let me add to this. There's also the measure on a bigger boost to NBFCs, specific NBFCs, which are into infrastructure financing.
Only operating assets.
Yeah. So again, what are the implications? And just because the framework has been eased, does it necessarily mean that we start seeing large ticket infra projects and credit growth take off around infra?
There, I'll wait for the detailed guidelines, because what they have said is operating assets, not new assets. So what it might mean is that people who are funding, running power stations and so on, credit to them through NBFCs would be supported. That's my understanding. I could be. It's not saying for new infrastructure.
Or new assets. It says operational assets.
Maybe,
yes.
Risk
There are assets that are already operational, and I don't think for a running operational asset there was ever a credit issue.
Absolutely.
Because if running well, their credit was always available. So we'll have to wait and see the details here.
We'll have to see the definition, right? But point is, if you have to, if risk weight is lower, then maybe the impact is not on, maybe on return ratios, etc. There's a bit of a bump.
It might little bit boost growth to those operating assets, but I don't think fundamentally change. This goes back to Surabhi's earlier question. Even this acquisition, I don't think in the immediate term going to do anything to get credit growth. Because number one, it will take banks some time to digest this and develop capabilities of doing this.
Correct. Absolutely.
And therefore, I think for the next year and a half, I don't see particular impact on this on industrial credit growth or business credit growth.
The other point is this current account bit, right? Where they're, I think, easing some stuff. Abhizar, did you see that point? Point number 10 basically.
Yeah.
So
Earlier there was this restriction that was put on for current accounts to say that unless you are 10% of a borrower, you should not be opening the current accounts for the same customers. I think the intent at that time was that normally banks took money from corporates took money from PSU banks, for example, and did all their banking or the flow of transactions to another bank for two reasons. One is that the bank was slightly more efficient in terms of transaction banking, and two, of course, in a way, it acted as a non-lien because the bank which lent the money did not see the flows happening through their own bank account. That is the reason why RBI said we will introduce this particular regulation. However, now what RBI says is let it be free flow. And I think which is the right thing to do because this was causing a lot of hindrance to corporate credit.
So the big, for our viewers, the big beneficiaries are essentially, your HDFC banks, maybe even something like a Yes Bank. It's the private guys essentially who are more efficient.
Yes, who are more efficient, and I think so be it. If they are more efficient, should they actually be getting the benefit of more transaction banking? They should. That will encourage some of our other banks, which are traditionally good lenders, to actually build more efficient systems in terms of transaction banking.
Okay, gentlemen, just quickly getting to the last two. I'll leave my most interesting one, the IPO bit, for the end. But before that, Basel III, are we ready? Because the implementation is now from the 1st of April 2027. So what could be the takeaways in terms of just the need for capital? Harsh?
Yeah, so I think for India, where most banks are on standardized approach, the only change would be the reduced risk weights. I think in Europe, it's making a change to banks which are on internal rating-based approach because there you could substantially reduce capital requirement. My own sense is in India, the impact is going to be somewhat marginal, depending on how much risk weights are reduced for the two segments that RBI has talked about. Beyond that, I don't see because everybody still is in a standardized approach and will remain so. So I think unless we have some brave banks moving to internal rating-based approach and RBI kind of countenances that, I don't see a very sizable impact of that.
Okay. All right, and Abhizar, quick last word with you. Very quick, 30 seconds. We've gone a little over on the discussion, but it is a big one and an interesting one. We keep discussing what's happening in the IPO market and how many 74 or 75 so far this year. Very interesting that now the limits have gone up from 10 to, I think, 25 lakhs in terms of IPO financing, and borrowing against shares has gone up to 1 CR. So just quickly, your thoughts on this.
I think because our equity markets are growing the way they're growing, I think RBI possibly sees the ability to actually fund and help people leverage to get into actual buying of stocks rather than playing in the options market. So I think this is the surrogate lending is now going to come on book lending, which is good in my view.
All right, we'll leave it there, gentlemen. Quick, sorry to have rushed both of you along, but and we'll have you back for a longer chat. Thanks very much, Harsh and Abhizar, for joining us. But really useful to go point by point and get both of your views. Really veterans who've seen the space over the years. We'll take a quick commercial break here. We're going to come back. Aman Chauhan of Abacus Asset Managers is also going to be with us. There was a story flashing on Niva Bupa, and Yash will be joining us for that as well. Stay tuned.
Welcome back. Nifty up 240 points. Bottom of your screen, I think we should get CAMS, that stock up for you on the screen. They're going to be considering a stock split. So that explains why that one has spiked up in trade. It'll shortly be getting flashed for you. And the other one is NMDC. Well, they have announced their September numbers. And out there, in fact, we have a 10% volume growth on a low base. So NMDC as well, Street was sensing that. Last month or so, the stock is up, I think, 9% or thereabouts. So Street was sensing that. 10% growth, Street will take that. And if I got it correct, I think we had Ashok Leyland's numbers that were flashing for you on the screen. That should come up at some point of time. Aman Chavan, fund manager at Abacus Asset Manager, joins us on the show. Hi, Aman. Good afternoon. Good to see you in. How are you feeling about the markets? Well, some of the investors are getting a little bit, worried. Last 1 year, no returns. Many stocks down 10, 20, 30% odd. Good time to buy?
I think the reason behind last year no return and the correction that we have seen in the recent month has been the global uncertainty. That has not changed as such. So I'm not sure whether this is the right time to buy or no. Markets can drift lower if this uncertainty stays, because then monthly export numbers are getting impacted for various sectors, right? And that's not something that is what market is going to like. So while domestically things are getting better, mostly the festive demand, this festive season this year will be much better than what it was in the previous years. But till the time the global uncertainty doesn't go away, I don't think markets are going to rush in a hurry.
Okay, Aman, you took the bails off there. I thought you were going to say, yes, it's a good time to buy. But as you're highlighting, the globe is still in a bit of a flux. And that's why, you'll have to watch out on that front. But since domestic themes are something that come to mind, and there are a lot of measures being taken on ground, monetary, fiscal measures as well. And some of these quarterly, monthly updates are not looking too bad. So the street will take heart from that fact and hope that second half of the year we see that earnings recovery. Give us a couple of themes that you like.
So that's true. Second half is definitely going to be better, and not just versus the first half, even versus the last year. So clearly, discretionary consumption is something that is going to do well. We expect demand also to pick up because of various capex as well as the government infra spending, which is back on track. So that should also tend to do well. So that two segments are doing well. We are also pretty positive on metals, though it's not just local demand globally, because the dollar is weak. The way precious metals are moving, we are feeling that the rub effect of that will be on other base metals also. That could also be a good theme to look at. So broadly, this is what we are looking at. Besides that, financials continue to be something that we are positive on. 2Q might be the last quarter where we'll see margin pressure. From 3Q onwards, the NIM compression of the margin pressure will start to wane off. And with the second half growth picking up, even the credit demand should pick up. So that's broadly the theme that we are looking at the current tension.
Aman, did you like anything? And broadly the space, right? Apparels. And that's an export story, though. Look at something like a Gokuldas, 1250 to 700, completely smashed. I'm just using that as an example. And of course, it's been on the back of these tariffs, and we were supposed to greatly benefit by lower tariffs. It's worked out the exact opposite way. How does one work through some of this in this space? I mean, if you like, or you have a view from a longer term perspective.
Yeah. So clearly, textile is one of the worst hit sectors because of the tariff. And the earlier assumption was India's tariff will be relatively better than the peer group, say that Philippines, Taiwan, Bangladesh, Pakistan, the other competing nations on the textile front. But as things stand today, things have reversed. We are not expecting this 50% tariffs to stay for long, that is for sure. But then whatever the number is, market is sensing that number could be similar or maybe even higher than the peer group. And if that happens, then India loses the competitive advantage. And maybe that is a bit reflecting in the way INR has also depreciated in the recent months. So keeping that in mind, I don't think anybody will be in a hurry to get into this sector per se, till there is complete clarity as to what the tariffs are going to be. And if it is a competitive tariff, then maybe some of the lost ground will be regained. Otherwise, stocks can languish for long, because US is by far the largest market, and not just largest, the most profitable market for these players. And if things there are not looking clear, I don't think investors will be in any hurry to get into these names.
Aman, hi. Great to have you on this afternoon. Season's greetings, festive greetings to you and your team, and to all at home. Now, since we're talking GST and consumption, I wanted to get your sense on autos. The kind of improvement that we're seeing in the sales numbers, very heartening. I mean, at least the September data. The question is this sustainable? Is this the start of a bigger uptrend, particularly in, say, passenger vehicles or even commercial vehicles for that matter? What's your sense? Do you like anything here? Auto or the entire chain? Maybe auto components. How are you thinking about it?
So clearly, yeah, 10% is a large cut that has come in, and there has been a lot of push-up demand as well as staggered demand that has come in from the auto space. So for the next few months, numbers are going to be much better than what we initially thought pre-GST. Post which I think the demand should taper back to the normal thing. Last few years, demand has been very soft, low single digit. We expect that to pick up, maybe to a high single digit kind of thing. So from that perspective, yes, the sector is looking good. It's overall the feel good factor, right? It's not just the GST cut. So that is the trigger. But if the economy has to do well, then this consumption discretionary segment should also do well. And autos definitely would benefit out of that.
All right. Aman, short a chat today and a bunch of more questions. Thanks very much for joining us. Have a good holiday tomorrow and festive greetings to you and your team and your family. Really appreciate you coming on. As always. Now, a bunch of stories we want to address as well. By the way, past the 3 p.m. mark, so just under 30 minutes to go for close. Niva Bupa, another company where potentially there is a large block which is coming. Yash is here with quick details. Yash.
Well, that's correct. A large block expected as far as Niva Bupa Health Insurance is concerned. What we've been given to understand from our sources is that the private equity player, that is True North subsidiary or True North unit, which is called Fettletone, is expected to sell up to 5% stake which it holds in Niva Bupa Health Insurance. The total stake as of the latest shareholding which Fettletone holds is about 8%, out of which the company is looking to sell up to 5%. What we've been given to understand from our sources is that bankers have already been approached as far as managing this particular transaction of a stake sale of 5% in Niva Bupa is concerned. This, according to our sources, could happen through a block deal itself, and the timeline that has been estimated to us by our sources is that it could happen as soon as in the month of November, that is next month. Roadshows, of course, would precede that. So a big block in Niva Bupa by private equity player Fettletone is what is expected.
Okay, all right. This is True North. The fund is True North. And this is Fettletone is a subsidiary in which this stake lies. Thanks very much, Yash, for that. So a long line of early investors, promoter stake sales, and one more to the list. We take a break. We are back. As always, we get you a check on what's happening in dealing rooms. D Street Chatter with Nimish coming up, and some technical trading ideas as well. Stay tuned.
Welcome back. You're tuned in to Closing Bell, and we are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, let's hop across to Hormuz. He's here. He's putting the spotlight on all the movers of the market. Hormuz, take it away.
It's been ages since you could say that today's day belongs to the index, so can't not talk about some movers on the index today. And one stock that has been making headlines almost every single day has been Tata Motors. It's up almost 5.5% now, and we've had close to 2.5 crore shares that have already traded today. Multiple announcements that have come in with regards to this. The 20-day average here being 90 lakh shares. And of course, Shriram Finance, the clarification that the management issued, Morgan Stanley too remains bullish on the stock. Here too, the stock is up around 5.5%. 13 lakh shares traded here compared to a 20-day average of 3.5 lakh shares. Now, when you go down to the broader markets, there is a stock called Dynacon Systems. The stock has gone up 15% in today's session, was up 3% yesterday as well, taking the two-day tally to 18%. It snapped a 7-day losing streak in yesterday's trading session, and today's move has come on volumes that are the highest since March of last year. So almost 18 months on, we've seen volumes of such kind, and we have had 17 lakh shares that have been traded already on the stock compared to a 20-day average of just over 17,000 shares. And as a result of this move, the stock has broken above its 50-day moving average, which was at 978. The next level on the upside is the 100-day moving average, which comes at 1,036. And October generally is a positive month for the stock. In the last 12 years, the stock has gained in 10 Octobers as per what the historical data suggests. Suryodaya Small Finance Bank, the stock has been buzzing all through the morning, and at one point the stock was up 20%, and at intraday gain was the biggest since September of 21. The third straight day of gains today, and today's volumes are also the highest on record for the stock. We've had close to 2 crore shares that have been traded today. The 20-day average is only a lakh, and that's the kind of volumes you've seen on Suryodaya Small Finance Bank. But a gross underperformer is still halved from its IPO price of 305 rupees. And lastly, Netweb Technologies, I wanted to mention about this yesterday as well. The stock is now up 10%, slightly off the highs of the day, extending its gains. September was the best month on record for the stock. The stock was up 65% in that month, and today's volumes are the highest since July of last year. We had more than 1 crore shares that have already been traded today compared to a 20-day average of just over 35 lakh shares. The stock listed in July of 23, a 500 rupee IPO price, and based on today's price, the stock is up 8x from those levels.
Okay, all right. Hormuz, thanks very much. Always an interesting set of stocks with Hormuz around this time. Well, time now for our D Street Chatter segment. Nimish is here with what he's picking up from dealing rooms. Nimish, afternoon.
Hi, Prashant. Afternoon. So, a good start to the new series, and that's what typically a series does. Extremely oversold levels and extreme short positions, and we've seen a bit of a short covering rally in today's market. It's largely led by financials, thanks to the RBI policy. A lot of changes there. So private banks are well bid, NBFCs and housing finance companies are well bid as well from large institutions. After a long time, some bit of interest seems to be back in the financial space after the RBI policy. The other space which has done a bit of short covering is the rate sensitive. So real estate names have done well today. All these real estate names have corrected 20-30% from the recent peaks, and you're seeing a bit of a covering rally in that space. Technically, 24,950 is a level to watch. If that gets taken out on the upside, you can potentially see further short covering rally in the days to come. So clearly, a big move led by short covering, but a bit of buying as well as emerge in the financial stocks after the RBI policy today.
Oh yeah, I mean the policy has definitely inspired the bulls going into the the holiday, the Sera holiday. What about stocks, Nimesh? What's on the radar?
Well, so the first stock on my list is Anantaraj. That's been buzzing in the last couple of weeks. It's flat today, but in general, in the last 2 weeks, if you see the chart, it's actually outperformed, and big volumes as well. The company was on a roadshow in the last couple of weeks, though non-deal. But now I understand the company might raise funds via QIP very soon. So that's the first stock and the trigger in Anantaraj. Second stock is Nykaa. That's been buzzing in trade today on back of very strong buying. And interestingly, there is a Morgan Stanley note as well. They put out a tactical buy, and they expect a very strong Q2 for Nykaa. So that's the reason why Nykaa is buzzing in trade. The third name is J&K Bank. Again, stock is flat today, but in the last couple of days, I understand one large HNI investor has started accumulating the stock again. Relatively, it looks cheap on valuations, but some bit of trigger there in terms of HNI buying back in J&K Bank. And the last is Sammaan Capital. There is a board meeting scheduled tomorrow for fundraising. I understand a very large sovereign fund is going to put in money via preferential issue, and that may trigger an open offer as well. So you've seen a big outperformance in Sammaan in the last 1 week, 10 days, but looks like the big deal is on the cards with the board meeting scheduled tomorrow.
Anantraj, Nykaa, J&K Bank and Saman Capital. So a couple of sort of fundraisers, deals very soon, and others on the radar. Nimesh, thanks very much for that. Well, let's just run you through what's happening on the F&O side of things as well. So I think Nigel has walked across with that data exactly. Nigel, over to you.
Well, that's right. You know, the Nifty Bank are doing well, but in terms of levels that you're looking at, you pull up the Nifty and the 20 DMA, that's the next level of resistance, close to around 100 points away from current levels. So that's the line in the sand you're looking at on the upside. The bears will want to defend that mark. On the Nifty Bank, it's crossed the 20 DMA. Now it's on its way towards the 100 DMA. So that's very, very close right now. You'll want it to take out that 100 DMA. So that's another important mark. On, in today's trading session, look at the options data. As we mentioned earlier today, the FI is aggressively net short, 94% of the positions on the short side. And after a while, we're seeing put writing that's taken over. Just take a look at the way those put premiums have collapsed. Both on the 24,800, 24,700 put as well. Premiums down anything between 70 to around 80% in today's trade. So the bulls will feel that they've managed to defend that lower level. Now they'll want the, to drive home the advantage and get closer to around the 25,000 mark. Just looking at two stocks, keeping it snappy out here, we have a possible stock that's coming out of the F&O ban. Very, very close right now. It was at around 82%. It needs to breach the 80%. Saman Capital, big board meet tomorrow. That could be a stock that could make its way out of the F&O ban. So it's very, very close on that one. But the one that's definitely coming into the F&O ban, at least as of the last count, is RBI Bank. Massive open interest built up. That looks set to make its way back into the F&O ban, when the file comes out today. And just take a look at the intraday chart. The stock again has got bought on the dip. It was down 4-5% earlier. At around 260, it's recovered to the highs of the day as well. So keep an eye out on that one, likely to move into the F&O ban. Back to you.
All right, Nigel, thanks very much for that. So that's the individual names in focus as well. 220 points higher on the Nifty, so 24,830. Mitesh is with us with what to do today for a reverse trade day after tomorrow's market holiday. Mitesh, what do you have?
So on the stock side, BTST on ICICI GI, that's ICICI General Insurance Company, keep a stop at about 1894, look for a target of 1925, and HDFC Bank is the other one. BTST here with a stop at about 959 for a target of 974.
Okay, all right. Two names from Mitesh. Mitesh, thanks very much. The flash at the bottom of the screen, the cabinet has approved a hike in dearness allowance for government employees. I think it's a 3% hike. And typically, there are some arrears, so this would be effective from an earlier date, which we should be able to get to you. I think it was 55%, it's moved to about 58% now, and some other decisions as well. Shares of Sun TV are higher in trade, and Elara is seeing more upside, 40-50% up from here. Vinny is here with the rationale and what the note says. Vinny, over to you.
Hi, yes, so we have Sun TV that's in focus. Obviously, yesterday we had reported saying that sources were saying that Diageo has put RCB up for sale and that there are potential buyers coming in. Valuation was at around $2 billion. Now, that is a big valuation number that's coming. What Elara is highlighting, that given this deal that may go through for RCB, that actually turns out to be a big re-rating that we could see coming in for Sun TV. Why? Because obviously they have Sunrisers Hyderabad. Now, obviously Sunrisers Hyderabad as of now contributes around 45% of the market cap. This is according to Elara, and while RCB is just 7 to 8% of United Spirits market cap as of now. Now, assuming that, there is a 20% discount for SRH versus the valuation that is taken for RCB, the $2 billion valuation, still the valuation for Sunrisers Hyderabad would come in at around $1.5 to $1.6 billion. And why is RCB at a higher valuation? Because they have a higher brand presence versus in terms of the branding and marketing that they have is much higher versus other teams. So valuation for Sunrisers would be at around a 20% discount. Still, a re-rating that could turn out to be for Sunrisers Hyderabad in turn for this. Currently, when you're looking at it, valuation contribution that comes in is at around 8,700 crores. Currently would go up now to 13,000 crores. That's the word coming in from Elara. And obviously a potential upside in terms of the market price that they see coming in for the stock price would be still 40 to 50% upside from these current levels as well.
Okay. By the way, volumes are the highest in the last 4 years on Sun TV. Highest since May of 2021. So this is not, the 16% pop is not back It's not on thin volumes at all. It's a very, very large volume, some 1.1 crore shares or so on the NSE.
Just 1 point, 23,000 crores of market cap. You have cash of 7.5 to 8,000 crores. I went through the annual report and got that number out. If you even value this IPL franchise at around 9-10,000 crores, or you're getting the core business at around 5,500 crores for a company that's doing a core EBITDA of around 2,000 crores. So valuation argument has been there. That got a little bit stronger. We'll have to see what plays out from here. But just, putting in the numbers together, the core valuation, made it a little bit attractive. So we'll have to see, first of all, what RCB gets sold at and what Sun TV does from here on.
Yeah, absolutely. Well, we want to focus on the other story, right, which is insurance. And this is important because insurers looks like they're effecting a very large cut in distribution, commissions. Much larger than what I think we thought. This is all source-based information. Yash is back with us with exactly that. Yash, take it away.
Well, Prashant, just last week we had reported, quoting sources, that general as well as health insurance companies together were discussing how to pass on the additional cost which their books were incurring because of the GST changes. At that time, the indication which was given to us by our sources in the industry is that the industry was looking to pass on about 5 to 8% of the cost to distributors like banks, like agents, like web aggregators, case in point Policy Bazaar. Now, what we've been given to understand from our sources is that the final cut which has been passed on to distributors is much larger than what was anticipated. As I said, what we were being indicated was about a 5 to 8% cut. But what has been passed on to distributors is a 18% cut in commission. What we've been given to understand is that the letters have been sent to various distributors communicating this particular pass on of the cost on their books. We've also accessed these letters which have been sent to distributors. And according to that, with an example, it's been specified very clearly that if we are paying you 1,000 rupees as commission on the sale of a particular product, now we would be paying you about 847 rupees as commission on the sale of same product, which means a reduction of about 18% when it comes to commissions being paid by general and health insurance companies to these distributors. Additionally to that, what we've been given to understand is that life insurance companies are also very close to making a decision on passing on the cost to distributors. So that will be additional, a cost burden which would come on the distributors. And, just on the day GST changes were announced, Yashish Daya of Policy Bazaar was on our channel, and he had indicated that about 20% of the revenue for Policy Bazaar and 60% of the value comes from health insurance business. This is the same business where the letters for the cut in commission of about 18% has already been sent to distributors.
And that explains why the stock, PB Fintech, it's down about 8-9% in the last 1 month as the market has been digesting this possibility, which has now become a reality, that perhaps this burden of zero GST that has to be borne by both the insurer as well as the insurance distributor, in this case, PB Fintech. Yash, got that. Thanks very much for getting us that story. And even now, the stock has reacted quite negatively, as Yash has put out the specifics of the magnitude of these cuts. Let's take a quick break, come back on the other side, and we'll get you more on the markets in just a bit. Welcome back. We are in the last leg of today's trading action. I think we've got Gurmeet with us for some quick thoughts. Gurmeet, hi. Festive greetings to you. This one's going to be a quick fire. We've had to digest so much, starting with the RBI policy. First, on banks and NBFCs, that's been the big trade of the day. Any thoughts, any new purchase decisions you may want to make because of what the RBI said today?
So, Shilpi, you will see, obviously, the limit have gone up on loan against shares. The group level cap has gone from 10,000 crores. So it will enhance corporate credit, includes more securities against which you can lend. So overall positive, both on yield and on credit demand. Also, we are seeing a lot of heightened interest by the Japanese firms like Mitsubishi and Sumitomo. Mitsubishi is now in talks, talking of Shriram. I think there were news of RBL Bank doing a fundraise of 3,500 crore, which could mean an equity stake of more than 20%. So you will see a lot of serious money now chasing NBFCs, and I think even MFIs are coming back after a bit of a slump. So it's looking very good for NBFCs and Tier 2 banks. And we've added RBL Bank, we've increased weightage to Bajaj Finance, we have Poonawalla, FinCorp and Chola in the portfolio.
Okay, all right. Quick word, Gurmeet. I remember you all were very bullish on CSK earlier, and you all got it much. I mean, I think at very depressed valuations. Now, suddenly hope that there's going to be some monetization of an IPL franchise, RCB. How do you read this and what are you bullish on right now?
So, Nigel, we're evaluating United Spirits if the valuation goes through. Also, if you see their Prestige and above segment has been growing volume-wise at 11% and values-wise 16% versus Popular. Then you have festive season ahead. And this is a very branded business. And I think a lot of cleanup, a lot of other stuff has happened. So that is something which could do well. CSK on the unlisted side, right now, if you see, it's available at about $180 or something. That's about 7,000 crore market cap, which is 800 billion. Now, if the deal happens at 2 billion, and I'm not recommending people to buy CSK, they could be re-rating on other franchises also. So Torrent recently bought, I think, Gujarat Titans at 7,300 crore. So there could be a bit of an uptick across the clubs, and then we'll have to see the linkages with the listed entities. But I think sports as a business, Nigel, will do well. Look at clubs across the globe, NBA leagues, soccer leagues, globally, they trade at 5 to 10 billion. So I'm not surprised if IPL franchising is finally touching $2 or $3 billion.
Okay, all right. Thanks a lot, Gurmeet, for giving us those quick thoughts. We'll have to wind down the markets now. Well, on the Nifty, good day, 230 points. It's been a while. It's been so long since we said something like that. The Nifty going home with gains. We had 8 sessions on a trot where we saw red. Today, green is the color and bright green. What did well in today's trading session? You had Tata Motors fueling up the engine, Shriram Finance as well. That was up and about. And from the banking space, Kotak Mahindra Bank did very, very well. Axis Bank as well did put on some good weight. Trent finding its feet yet again. And Sun Pharma, all of them went home with good gains. What was the problem?